All right, good afternoon, everybody. Hope everyone is doing well. This is Ryan Bouchey, and I'm joined today by my colleagues Marty Shields and David Rath, and we'll be going through the first quarter webinar titled The Rebound. So just a quick housekeeping, we do these quarterly. We did not do one after the fourth quarter because we had the State of the Economy presentation, but ongoing basis, we will be continuing to do these quarterly. So continue to just look for the invites from Harmony, and we'll continue doing these. This is a great opportunity. Most of you know Marty Shields. I'm sure you've spoken to him or heard him on the webinar. This is David Rath's first time joining us. He is new to our firm as of beginning of the year, January 2nd. He is our portfolio strategist and a CFA, so he will get into some good stuff as it relates to interest rates and the Fed, and that'll be upcoming in the webinar. So with that, this is a new platform that we are using. We had some technical difficulties the last time we did our quarterly webinar, so this is a new platform. It's working very well, but if you can just make note, if you have the option to mute your recorder on your side, please make sure you do so. We are, again, working through some of the nuances of the new program, but definitely you want to keep your side muted. So with that, why don't we get into it? And lastly, if you do have questions, you can reply to the email that came from our firm. We will try to answer them at the end of this webinar if time permits. So again, with that, let's move on to the start of the webinar. So here's the first quarter. Obviously, we like this chart a lot more than maybe the chart from the fourth quarter. As you can see, we had great growth in the NASDAQ, was up a little over 16% for the first quarter, the S&P up about 13%, and the international index, the MSCI EFA, up about 9%. So a lot of strength throughout both U.S. indices as well as globally. And you can see just through the chart, very little volatility as we've gone through this first quarter. We want to show you the comparison of the fourth quarter to the first quarter of this year. I mean, quite a divergence, almost the perfect V between the two quarters. And I think the thing to remember when looking at a chart like this, and many of you are, being a long-term investor, it can be hard when you look at, as we got through the fourth quarter, got through about mid to end of December, especially about Christmas Eve when markets bottomed out for that time frame. Really hard to be disciplined and to stay invested, but obviously if you did so, the first quarter has so far rewarded you for that discipline. Love looking at this side by side. So this red chart on the left, we used this in our State of the Economy. That was the full year of 2018, really showing you, different U.S. sectors, international markets, fixed income side, and really the only area that was up for the year was volatility indices and volatility trackers. So, you look at this 2018 chart versus the all green for the first quarter of 2019, and we've had just such a great start. Really the only negative areas of the market for the most part are some inverse ETFs and indices, which are doing the opposite of what the market's doing. Some U.S. volatility indices and some commodities. But overall, most sectors, most areas of the globe have been up so far year to date. And, that is with some headwinds that we've experienced that we're going to talk about later in the presentation. Again, we'll just quickly go over the market performance. So I don't want to get into the details of all the numbers, but obviously 2017, we had an incredible year. All across the globe, very strong returns. You see the first three quarters of 2018, again, very strong outside of maybe emerging markets. And you see just what the impact of the fourth quarter of 2018 could do. And again, just stressing that importance of discipline and, not only that, but when you look at the U.S. bond index for the fourth quarter, we spoke to a lot of clients last year that asked why do we hold bonds when we have interest rates rising and the market doing as well as it does. Well, you look at the fourth quarter and you see the strength of the U.S. bond market, and that's where diversification plays in. And again, we'll talk about that a little bit later in this presentation. And just sort of where we stand, I mean, we talked about it a little bit in the State of the Economy. If you weren't able to join us, currently right now, again, we continue to be overweight U.S. equities. the technology sector, which makes up a lot of that NASDAQ strength that we looked at earlier, financials, healthcare, and we did add to what we would call defensive equity earlier in the year. We did so after we captured most of the gains that we saw in the first quarter. We did become a little bit more defensive and go into maybe some higher yielding dividend funds to, again, with some of the headwinds that we're seeing and what we're experiencing in the market, we thought this was a good strategy, and so far it's paid off in the portfolios. And again, we'll talk about a little bit later as to why that strategy we went with it and what we saw and how it's playing out so far year to date. Continue to be underweight international equities and some of maybe those more high volatility areas that we sold off of earlier this year. And again, we'll discuss the reasons why we did that. So with that, I'm going to turn it over to David Rath. He's going to discuss a little bit of the interest rate environment and what that means for the Fed and moving forward in that area of the market.
How's everybody doing? As Ryan mentioned, my name is David Rath. I'm the portfolio strategist here at Bouchey, and it's been a great 3 months so far, a little over 3 months, not only for my tenure, but also in the market. And I'm here to talk about everybody's favorite topic, especially recently, which is going to be the inversion of the yield curve and Fed policy. So I hope everybody stays awake. And as you can see, this cartoon is showing both bulls and bears are hanging on every word that Fed Chairman Jerome Powell has to say. So we're really taking the direction that we see in the market from what the policy of the Federal Reserve is. This is showing a comparison of the yield curve between last year and this year. As you can see, last year the bluish purple line is showing an upward slope on the short end of the curve here, and this year we're showing much more of a dip. So the higher yields are coming in the short end of the curve versus where we're seeing farther out in the curve. My goal today is to keep a pretty high level conversation going around some of the mechanics that are at play here and understanding why the yield curve moves as it does. And first, the short end is controlled by Federal Reserve policy, and they're in charge of two things in the economy. The first is making sure that we have maximum employment, but their constraint is that they can't let inflation or they can't let prices run away from them. So the reason why they raise the short end of the curve is they want to get out ahead of inflation. And as we've seen in the past, sometimes they're successful with curbing inflation at the outset. Sometimes they really have to rush to increase those short-term rates to get ahead of inflation. So right now they raise those interest rates again to position themselves so that inflation doesn't run away from us. On the longer end of the curve, that's much more of market forces at work. And market forces are going to be determined by people wanting to hold these bonds. And again, the basic relationship between bond prices and yields is as people have more of a demand and prices go up for bond, the yields go down. And the reason why people would want to hold bonds out on this end of the curve is because they're looking at growth expectations, inflation expectations, but also looking at holding just safer assets. So that's part of what causes the yield curve to move as it does. Now, this is a chart that I'm sure a lot of people have seen showing the inversion of the yield curve followed by recessions. And as you can note, we're right on that line that would show that curve going into negative territory. So everybody's asking, what does that mean for the economy in the future? And the economy, it could depend on a variety of factors. As you can see, there's a different time between when it's inverted in the past and when we've actually gone into those recessions. So it's incredibly difficult to predict not only the time, but also if there would be a recession at all. So we've seen in the past, sometimes we have inverted and then we haven't seen a recession. So this is something that's going to be very hard to predict moving forward. We included this slide in a previous webinar, and the basic understanding is that higher yields are bad for bonds. And why is that? So if you were to hold a portfolio of bonds and interest rates, the prevailing interest rates were to go up, the value of the bonds that you hold within that portfolio are going to go down to adjust for those increasing interest rates. Higher yields are actually good for bonds because as those interest rates go up, sure, the value of the portfolio that you're holding might go down, but those interest payments that are coming from those fixed income securities that you're holding are now being reinvested at higher rates. So this graph is really showing that the starting yield for any sort of investment that you're making is going to determine what's going to be that ending return for that fixed income part of your portfolio. Now, it comes with a word of caution. So a lot of people, especially in a low rate environment, are hunting for yield. And so what you'll see is them kind of sitting out in this part of the graph where it's much more of an equity-like risk return profile. So our high yield funds, our emerging market funds. So it's always good to be aware of exactly what you're getting into when you're constructing that fixed income part of your portfolio. So if you're hunting for yield, you have to make sure that at the same time you're not exposing yourself to too much risk. So when we're constructing our portfolios, we like to sit in this area mostly because we want fixed income to act as the stabilizing part of the portfolio. Now, what's next for the Fed? I think that everybody wishes that they could tell that, including members of the Fed. They're constantly adjusting their policy or their outlooks for where they believe the future of their interest rate, the one that they set the federal funds rate, where that's going to be. Now, based on their meeting minutes, their expectations are in this line right here, 2.38, 2.63, and then a long-term rate of about 2.75. Now, the market thinks something different. The market actually believes that the next move for the Fed could actually be a cut. So there was a lot of discussion in December whether they should have raised or not, and the market now believes that they might go back on that. Just to, again, back to our earlier discussion, if they're not seeing the inflationary forces, they might hit pause for a little while or even cut to get back to that rate where it's maximizing the employment numbers, but at the same time not letting inflation run away with it. So as you can see, there's a lot of different considerations when examining the level of interest rates, the yield curve, the Fed, the decisions made by the Fed. So that's what we do every day, especially that's what I do every day is gather as much information to put our best foot forward when we are constructing our portfolios. And with that, I'm going to hand it off to Marty Shields, and he's going to go through some slides regarding the economic outlook.
Thanks, David. So the first thing we want to talk about is the duration of this economic expansion and the rate of growth that we've seen. So this chart shows you the expansion of a number of different periods, and you can see most of them are connected, are very close in the rate of growth, around 3 to 4%. The blue line is the most recent expansion that if we hit July with continued expansion, we'll break a record of over 10 years. But what you can see with that expansion is that it's at a much slower growth rate than all the other expansions. So you've heard the term the new normal growth rate, which is somewhere in the 2% range. And that really has been indicative of what we've seen over the last 10 years, and really is one of the things that could allow this expansion to continue because it hasn't been as dramatic as the other expansions that we've seen over the last 30 years. When we're looking at the data and trying to understand are there any risk out there, we talk about the concerns over bubbles and just looking at major parts of the economy to determine where we stand. This chart looks at automobile sales and part consumption as a percentage of GDP. And what it shows you is, relatively speaking, versus the average consumption in that area versus as a percentage of GDP, we're well below what that trend rate is. And what that says to us is we really have no concerns, particularly in this area, of any bubble or any concerns of a sharp decline. And if anything, we got room for growth in that area. Same thing when we talk about residential investment. New home construction has been well below historical averages, and we really could be in a situation where we're going to see more growth. Now, what you do see here is that in the fourth quarter of last year, residential investment actually started to decline a little bit. And that was the concern in the latter half of last year with interest rates increasing, that existing home purchases and new home construction was starting to decline a little bit. But what we've seen already in the first quarter is that is changing, that there's been some stabilization in new home construction and existing home sales. And a big driver behind that, beyond the strong labor markets, is the decline in mortgage rates. So as this graph shows you, mortgage rates almost hit a high of 5% on a 30-year mortgage last year, and now we're down around 4%. So this has made homes much more affordable than what we saw in the latter part of last year, and is really providing some stabilization to a fairly large part of the economy. We talk about the importance of consumer spending, and as this graph shows you, this is year-over-year change in consumer spending, that we're still seeing growth in this area. And as long as we continue to see some reasonable growth over 2%, that should be a very positive signal for the economy and growth in the economy. But we will continue to watch it. As you can see, we're a little bit off of some of the highs that we saw over a prior few quarters, but just more recently a kind of a bump up. So again, an area that we're watching very closely to make sure that you continue to see growth in consumer spending. And also with manufacturing. With this chart, it basically looks at, it's called the ISM Manufacturing Index, and it's looking at whether there's growth in the manufacturing sector. If the number's over 50, that means that that sector is growing, and you can see we're quite a bit over 50. Now, it has declined again a little bit off of its high, so the trend is heading down, but still that area is continuing to grow. So an area that is still positive for the economy, and we'll continue to watch just to see if this trend continues downward or if we start to rebound a little bit from that downward trend. We talk about the importance of GDP growth, and I mentioned that that new normal that we've seen over the last 10 years at around 2%. Last year, we saw some spikes above that with GDP growth over 3%. And in large part, as you can see, that occurred right after the tax reform bill of 2017. And that really was driving that higher growth rate. We're starting to see us go back to that new normal of growth rate around 2%. And expectations are it's going to be in that range, maybe in the 1% range as well, but certainly not in the 3 to 4% range, but still positive growth for GDP over the next few quarters. And we talk quite frequently, and David mentioned earlier, about the importance of inflation staying in a reasonable range. And from the Fed's perspective, their target for inflation is 2%. So as long as inflation stays below 2%, that allows them to basically act in a dovish manner, which means that they would be not likely to raise rates and even be potentially in a situation to lower rates. So again, we're always watching inflation, and if there's any spikes in that, because if there were a change and it would increase, that could mean that the Fed has to act more aggressively and actually raise rates. And we saw what that meant in December when they did raise rates in December, that the market acted in a negative fashion. Consumer confidence looks very good. It's still at elevated levels, and that's positive to the extent that it allows consumers to spend more, which is very important. The one element that we do highlight with this, though, is if you look back at other times, like in around 2007, consumer confidence can peak before it declines before a recessionary period. So again, with a lot of these indicators, we're looking at where do we stand now, and also what is the trend that we're seeing with them. We talk about the importance of corporate earnings. Really, at the end of the day, it's what are corporations earning, and what is their future cash flow. When you look at 2018, you saw really strong quarterly earnings growth, 27% in the first two quarters, and then 32% in the third. A decline a little bit from that, still positive earnings growth for fourth quarter, but in large part that was driven by the corporate tax reform. It was also driven by increase in revenue. But as we're looking at the first quarter earnings that just starting to come out, expectations are that earnings are actually going to decline for the first quarter, even though revenue has increased by almost 5%. And so what you're really seeing there is profitability taking a bit of a hit with increase in both labor cost and raw materials. So the last time that we saw earnings negative was back in 2015. If you recall, that's when oil really dropped, and those negative earnings in the S&P was almost entirely because of the oil sector. Before that, it was '08 where you saw negative earnings. So really, as this next graph shows you, in order for the market to keep going higher and even sustain these levels, we need to see earnings growth over the next number of quarters really be positive. So as this graph indicates, we're seeing the expectations of earnings are going to rebound in the second and third and fourth quarter. And again, we'll be looking at what corporations are coming out with as far as first quarter earnings, and also what their projections are for the remaining part of the year, because that's going to be very important to provide direction for the markets over the next 3 quarters. In general, we've talked about a lot of positive news that we see in the markets that can propel the markets forward and in the economy. One of the things we talked about just watching and making sure that we're seeing a direction on this is the relationship between the unemployment rate and earnings, wage growth. So this looks over the last 30 years. The orange line is the unemployment rate, the blue line is wage growth. And what you can see is before a number of different recessionary periods, these two data points come very close to one another or intersect. You do see periods like the 90s where that was the case, but it was 4 or 5 years before a recession. So we are fairly close with those two numbers now, and we'll be watching to see kind of what the trend is as we move forward. Switching gears quickly to international, when you look at global trade, it has been positive over the last 6 or 7 years, and this is what this is showing you, that trade has increased year over year, still below the average for the last 25 years, but positive. In January was the first month that you actually saw negative trade growth, or it actually saw trade decline. So we think that's in large part from the trade wars. So again, if you can have a resolution between China and the U.S. With all the tariff issues, that may help trade rebound, but something that we're watching. And the question becomes, how come the U.S. hasn't really been impacted by it? And that what this chart shows you is, if you look at overall exports as a percentage of GDP, and look at a number of different countries, anywhere from 12% up to 57% for that percentage. When you look at the U.S., we're only at 8%, right? So although international trade is very important to the U.S. economy, relatively speaking to versus other countries, it's very limited. So that's what we talk about, which is, it's always important to have a strong global economy, but really when we talk about the health of the U.S. economy, it's more internally based versus what's going on with other countries. And that's really shown in this graph here, which is basically looking at global recessions. And what you see here is the blue line is an indicator of when recessions might be occurring from a global perspective, and the gray bar is actual global recessions. And what you've seen is we really could be in a global recession right now, and that it has occurred actually over the last 10 years twice, around 2015 and 2011, where there has actually been a global recession, but the U.S. has not been impacted. So the question is this going to be a period like 2011, 2015, where there's a global recession, but it doesn't impact the U.S., or it could be more like '08, where eventually the U.S. Goes into a recessionary period. Okay, now Ryan's going to join you to wrap up the conversation.
All right, thanks, Marty. So really, what are today's big takeaways? So a couple slides that we want to focus on here. How to make money in stocks. And we talked about some of the moves we made in the portfolios earlier in the quarter, and looking to become, in our equity holdings, maybe a little bit more defensive, looking to get higher yielding equities. And that helps us in 2 ways. One, as I mentioned, they tend to be a little bit more defensive if we do see volatility. Now, so far, year to date, we haven't seen that volatility, but we know, looking at the charts from last year, that can change quickly and without a lot of warning. So, this stage in the market and economic cycle, we felt prudent in terms of adding some of those more defensive equity positions to the portfolio. And as you look at this graph, the gray bar, so these are all different sectors in the S&P 500. The gray bars are the capital appreciation, right? How the market price goes up and down. In the green area of the bar chart is dividends. And certain sectors are going to pay out more dividends. And right now, like I said, adding a little to energy, to financials, those dividends may hold up well in a volatile period. The other thing too, and we talked about a little bit, is we've seen the 10-year interest rate come down, and having higher yielding positions can also be a good thing in this current interest rate environment, especially if as the year goes on, the Fed either continues to not raise rates or even reverses course and decides to lower rates. The importance of diversification, and I touched upon this a little bit in our opening slides, talking about that fourth quarter and how we saw that sharp reversal in the bond area of the market, because it had been doing so poorly as rates were going up, especially when you look at how they were doing versus U.S. equities in particular and all the strength. But as we saw, that can reverse itself very quickly. And everything above that black middle line is a positive correlation. And what a positive correlation means is stocks and bonds are moving together. Anything below that, stocks and bonds are essentially moving in opposite directions. And having that negative correlation and having different elements in your portfolio is a good thing. If you ever saw your portfolio and in every position, this is a quote that I love using, but if every position in your portfolio is going up, or on the flip side, everything is going down, you're probably not well diversified. And having those positions all go up together certainly seems good in the short term, but over the long term, that can really impact the market, your portfolio, especially when we have some down markets or volatile markets. We want to have that diversification. We're okay with some losing positions from time to time, because we know if the market reverses itself, those positions are going to hold up. And that's what bonds did last year for us in the fourth quarter. And so as investors, the last thing we want to have happen is someone be, an aggressive investor throughout most of the year, decide to become more conservative in the fourth quarter, towards the end of the fourth quarter, because of all the volatility, and then all of a sudden now at the end of the first quarter say, hey, I'm ready to become more aggressive again because the market's up. That's the last thing. We really want to focus on what that risk tolerance that you are most comfortable with and what is most appropriate for your financial goals and long-term future needs. And lastly, as we head into 4/15, where we're less than a week away, want to just touch upon some last-minute tax tips. If you have not contributed to an IRA, whether traditional or a Roth, you still have, even for 2018, you have until the filing deadline to do so. For last year, the limits were $5,500 if you were under 50 and $6,500 if you were over 50. Again, if you haven't done so, but you think you may qualify or you want to talk to an advisor here, please give our firm a call and we can get any last-minute contributions in for you for the 2018 tax year. Just to be aware of heading into 2019, limitations are going up by about $500 in certain cases in the 401k space, the IRAs, and the simple IRAs. Estate taxes, lifetime exclusion has gone up, but your annual gift exclusion remains unchanged at $15,000. And lastly, maybe you do not qualify for either a traditional IRA because maybe your work has a qualified plan there and your income goes above the threshold, or for a Roth IRA, again, you earn too much and your AGI is too high to qualify for any Roth contributions. There may be the ability to do a backdoor Roth contribution if your income is too high, depending on what your other assets and what your holdings are. So it's something to consider. Like I said, if you feel you may not qualify for a Roth IRA, we could look into your assets and what you hold now to see if you may qualify for a backdoor Roth contribution that we could take care of for you. So with that, I don't believe we received any questions. So we'll show you our disclosures. And again, be on the lookout. At the end of next quarter, we will do another quarterly webinar. And even before that, we're looking to do some financial planning or retirement planning type of webinars in between our quarterly market webinars. So again, just be on the lookout for any emails from our firm to have you participate in these future webinars. Again, we thank you for joining and have a great rest of your day.